Chapter 3. Date. Financial services. Financial services. Meaning, objectives, functions, features, types of financial services. 1. Merchant banking, functions and operations. 2. Leasing. 3. Mutual funds. 4. Venture capital and credit rating. Objectives of financial services. Meaning of financial services. Financial services can be defined as the products and services offered by financial institutions like banks of various kinds for facilitation of various financial transactions and other related activities like loans, insurance, credit cards, investment opportunities and stock market and issues like market trends. Dow. The objectives of financial services are to 1. Raises fund. To 2. Promotes savings. 3. Development of funds. Minimizes risk. 5. Economic growth. 1. Raises fund. Financial services provides various financial instruments to individuals, investors, corporations and institutions where they can invest their money, thereby raising funds from them. 2. Promotes savings. Financial services provide different types of convenient investment options that can grow people's savings. A mutual fund where people can invest and earn reasonable returns without much risk. 3. Development of funds. Financial services enable the proper development of financial resources into productive means. There are various investments and instruments available in FM where people can invest their funds for earning income. 4. Minimizes risk. Financial services help diversifying the risk and protect people against damages by providing insurance policies. Risk minimization is an imp role played by FS. 5. Economic growth. Financial services help the government in attaining the overall growth of the economy. It helps in improving overall infrastructural facilities and employment opportunities in a country. Functions of financial services. Meaning of financial services. Financial services can be defined as the products and services offered by financial institutions, like banks of various kinds for facilitation of various financial transactions and other related activities like loans, insurance, credit cards, investment opportunities and stock market and issues like market trends. Date. The functions of financial services are 10. Mobilization of funds. 2. Effective utilization of funds. 3. Transferring risk. 4. Enhancement of economic development. 5. Provision of liquidity. 6. Creation of employment opportunities. 1. Mobilization of funds. A financial service helps in mobilizing funds from investors, individual, institutions and corporate entities through different financial instruments, like equity shares, bonds, mutual funds, etc. 2. Effective utilization of funds. These financial services also help in effective utilization of mobilized funds. Financial services helps in this regard through services like factoring, securitization, credit rating, etc. 3. Transferring risk. Financial services like insurance helps in reduction of risk by transferring risk to those who are more willing to bear it. 4. Enhancement of economic development. A financial services help in economic development of the country by mobilization and development of funds and effective utilization of bands mobilized savings of individual. 5. Provision of liquidity. The financial service industry promotes liquidity in the financial system by allocating and reallocating savings and investment into various economic activity. It facilitates easy conversion of financial assets into liquid cash. Vidya 19. 6. Creation of employment opportunities. The financial service industry creates and provides employment opportunities to millions of people all over the world. Characteristics of financial services. Meaning of financial services. Financial services can be defined as the products and services offered by financial institutions like banks of various kinds for facilitation of various financial transactions and other related activities like loans, insurance, credit cards, investment opportunities in stock market, and issues like market trends. The characteristics of financial services are: 1. Customer-oriented. 2. Intangibility, related. 3. Concomitant, contrat. 14. Perishable in nature. 5. Dominance, control of human element. 6. Advisory. 7. Heterogeneity. 8. Information-based. R. 10. 1. Customer-oriented. Evenemer financial services are provided depending on the need of customer. For example, while merchant bankers' servings may be needed by a company issuing new equity share in the market. Date. 2. Intangibility. Financial services are intangible in nature. In a highly competitive global environment, brand image is very important. Intangibility means cannot see, thus services cannot be seen. 3. Concomitant. Production of financial services and delivery of these services have to be concomitant related. Both these functions, production of innovative FS and supplying of these services, are to be performed simultaneously. 4. Perishable in nature. Like other services, financial services also require to match blue demand and supply. Services cannot be stored, they have to be supplied when customers need them. 5. Dominance of human element. Financial services are dominated, controlled by human element. Thus, financial services are labor-intensive. It requires competent and skilled personnel, employee, to make the quality financial products. 6. Advisory. Financial services can be of 3 types, i.e., a fund-based or a fee-based or both. In case of fee-based services, the advisory function is dominant. Control. Asset, merchant banking are examples of advisory financial services. Variety. 4. Heterogeneity. Financial services are customized services. It cannot be uniform for all clients. Financial services vary from one client to another client after analyzing the needs of clients. Services provided to clients. 8. Information based. Financial service industry is an information-based industry. It entails creation, dissemination and use of information. Information is an essential component in the production of financial services. Types of financial services. 1. Traditional financial services. Fund-based services. Fee-based services. 3. Modern financial services. 1. Traditional financial services. It includes services rendered for both money market and capital market. A fund-based services. It refers to services that are used to acquire assets, funds for a customer. It consists of primary market activities, secondary market activities, foreign exchange activities, specialized financial services. Important fund-based services include 1.1. Leasing. 2. Mutual funds. 3. Credit financing. 9. Venture capital. 5. Hire purchase. 6. Bill discounting. Date. Fee-based services. When financial institutions operate in specialized fields to earn income in form of fees, commission, board brokerage, or dividends. It is called fee-based service. Important fee-based services include 1. Merchant banking. 2. Issue management. 3. Portfolio management. 4. Corporate counseling. 5. Stock broking. 2. Modern financial services. 1. Acting as trustees to debenture holders. 2. Undertaking risk management services through insurance. 3. Advert advising clients for selecting the best source of funds. 4. Structuring the financial collaboration through joint ventures. 5. Guiding corporate customers in capita restructuring. 6. Planning for MOA and AOA for smooth carry-out. Video. Services provided by merchant bankers. Meaning of merchant banking. Merchant banking can be defined as a skill-oriented professional services provided by merchant banks to their clients concerning their financial needs for adequate consideration in the form of fee. The services provided by merchant bankers are 1. Providing loans to companies. 2. Raising funds from new instrument. 3. Estimating the amount of funds required. 4. Portfolio management. 5. Loan syndicating. 6. Project counseling and market survey. Operations, functions of merchant banks. Meaning of merchant banking. Merchant banking can be defined as a skill-oriented professional services provided by merchant banks to their clients concerning their financial needs for adequate consideration in the form of fee. The functions of merchant banking are 1. Portfolio management. 12. Poising funds to client. 3. Broker in stock exchange. 14. Managing public assets of companies. 5. Services to public sector units. 6. Money market operation. 1. Portfolio management. Merchant banks provide consultancy service to institutional investors on investment decisions. They trade and exchange securities on behalf of their clients and also manage their portfolio. 2. Raising funds for clients. Merchant bank help their chant business firm to raise funds, capital, from domestic and in KR national market by issuing securities. This helps business firm for expansion of their activities. 3. Broker in stock exchange. Merchant banks act as broker for their client in stock exchange. They conduct research on equity shares and they advise their clients about which shares to buy, when to buy, how much to buy and when to sell. 4. Managing public assets of companies. Merchant banks help in imparting underwriters and brokers at time of issue. Merchant banks advise the size and price of public issue acting as a manager to the issue. 5. Services to public sector units. Merchant banks provides the facilities to raise long-term capital, marketing of securities and arranging of long-term finance from term lending institutions. B. Offer DFF services to public sector units. 16. Money market operations. MB deal with underwriters and also with short-term financial instruments, such as Gov bonds, plus commercial paper issued by large corporate firms. Asterisk the Treasury bills issued by the government. Date. Advantages and disadvantages of leasing. Meaning of base. Less. A lease is a contract under which one party, the lessor, owner of the asset, gives another party, the lessee, the exclusive right to lose the asset, usually for a specified, fixed time, in return for the payment of rent. The advantages of lease financing, OSD. 1. Saving of capital. 2. Flexibility and convenience. 3. Planning cash flows. 4. MSP shifting of risk. 5. Maintenance and specialized services. 1. Saving of capital. Leasing covers the full cost of the equipment used in the forcement by providing 100% finance. The lessee capital will not become expenditure, rather than it will be safely with lessor. 2. Flexibility and convenience. The lease agreement can be tailor-made in respect of lease period and lease rentals according to the convenience requirements of the lessee. 3. Planning cash flows. Leasing enables the lessee to plan its cash flows properly. The rentals can be paid out of the cash coming into the business from use of the same assets. 4. Shifting of risk. The lessee can shift the risk upon the lessor by acquiring the use of assets, rather than buying the asset, because buying an asset requires huge capital investment to the law firm. Advantages and disadvantages of lease financing. Meaning of lease financing. Lessor. A lease is a contract under which one party, the lessor, owner of the asset, gives another party, the lessee, the exclusive right to use the asset, usually for a specified, fixed time, in return for the payment of rent. The advantages of lease financing are: lessor. 1. Higher profits. 2. Tax benefits. 3. Quick returns. 1. Higher profits. The lessor can get higher profits by leasing the asset. 2. Tax benefits. The lessor, being the owner of an asset, can get quick returns than investing in other projects of the long claim. Various facts. Benefits such as depreciation. 3. Quick returns. By leasing the asset, the lessor can get quick returns than investing in other projects of the long period. The disadvantages of lease financing are: lessor. 1. High risk of obsolescence. 2. Price level changes. 3. Long-term investment. 5. Maintenance and specialized services. In the case of special kind of lease-ag arrangement, the lessee can avail specialized services of the lessor for maintenance of asset lost. The disadvantages of lease financing, lessee, are: 1. Higher cost. 2. Risk. 3. No alteration in asset. 14. Penalties on termination of lease or works on. 1. Higher cost. The lease rental includes a higher cost which have to be given to lessor of the time of agreement for lease financing of an asset. 2. Risk. Lease financing is risk of being when the use of the assets, in case the company words. Op. 3. No alteration in asset. Lessee cannot make changes in assets, as per his requirement. 4. Penalties on termination of lease. The lessee has to pay penalties in case he has to terminate the lease contract before the expiry lease period.